Hello, everyone, and welcome to Fingraph India. If you're a CA, CS, or BCom student, or maybe you're just diving into the fascinating and yes, sometimes slightly crazy world of taxation for the very first time, you are in exactly the right place. Okay, let's dive into this. Today, we're demystifying Section 7 of the Income Tax Act, 2025. Now, you might be wondering, why are we focusing on this specific section? Well, because Section 7 deals with a concept that fundamentally changes how you calculate taxable income, and it is an absolute favorite for examiners. We're going to break down the actual logic behind the law. That way, you aren't just blindly memorizing sections, but you're actually understanding how taxation works in the real world. Right, so here it is. This is the official text of Section 7, straight from the Government of India. I know. When you open your tax modules and see this massive, dense, unbroken wall of legal text, your very first instinct might be to just panic or skip it altogether. It looks super intimidating, right? But hey, don't worry. As a commerce student, learning to read bare axe is basically a superpower. In this explainer, we're going to dismantle this exact block of legalese piece by piece. It's like a giant puzzle, and we'll extract the core meaning so that by the time we're done here, you'll be able to look at this document and know exactly what the lawmakers intended. So here is our roadmap for today's explainer. First up, an introduction to Section 7. Second, Section 7.1, covering employees' funds. Third, Section 7.2 on dividend income. Fourth, we'll do a comparison of dividend types. And finally, we'll wrap up with a quick Section 7 revision summary. Let's kick things off with Part 1, Introduction to Section 7 and the whole deemed concept. The title of this section relies heavily on arguably the most dangerous and most important word in tax law, deemed. So the crucial point of this, deemed to be received, means the income tax department is treating the money as if it is already sitting right there in your pocket, completely regardless of whether you can actually touch that cash right now. Imagine your employer, let's call them Tech Corp, puts your yearly bonus into a locked trust fund that you literally cannot access for 5 years. You might think, well, I don't have the cash, so I shouldn't have to pay tax today, right? But the government steps in and says, nope, we are deeming this as received right now. The whole logic here is anti-avoidance. The law basically prevents taxpayers from deliberately delaying the physical receipt of cash just to postpone paying their taxes. Keep that logic in the back of your mind, and the rest of Section 7 is going to make perfect sense. Moving right along to Part 2, Section 7, Subsection 1, which covers employees' funds. The Act outlines 3 very specific scenarios under Section 7.1, where income is deemed to be received. First up, the annual accretion in a recognized Provident Fund. Think of annual accretions simply as the growth of the fund. The interest credited and the employer's contributions during that specific year. Second, the transferred balance in a recognized Provident Fund. And third, contributions made by the central government or an employer to a specific pension scheme. Now listen, these exact phrases, annual accretion, transferred balance, and pension contribution, these are the golden keywords your examiner is going to be hunting for on your answer sheet. Okay, let's drill down into an exam-focused detail that literally separates average students from the top scores. For clauses A and B of Section 7.1, which deal with the annual accretion and transferred balances, the law doesn't just apply to any random savings account. No way. It specifically mandates that this must be a recognized Provident Fund. Furthermore, the extent of this deemed income is governed strictly by the rules laid out in Paragraph 6 and Paragraph 11 of Part A of Schedule 11 of the Act. I'm telling you, when you're writing your answers, casually dropping a citation like Schedule 11 Part A shows a level of precision that examiners absolutely love. It's a real game changer for your marks. Now, moving to Clause C regarding pensions. And this brilliantly illustrates just how specific tax law can be. Not all pension contributions trigger this exact clause. It is explicitly the contribution made by the central government or any other employer in that tax year to the account of an employee under a pension scheme mentioned specifically in Section 124. This is a highly targeted provision. Understanding these exact boundaries ensures you don't accidentally apply Section 7 where it just doesn't belong. For example, if your client voluntarily puts money into some private, unapproved mutual fund for their retirement, this specific clause simply does not apply. Make sense? All right, let's shift gears to Part 3, Section 7.2, focusing on corporate dividend income. Let's look closely at the exact text of Section 7.2a. It states that any dividend declared, distributed, or paid by a company shall be deemed to be the income of the tax year in which it is so declared, distributed, or paid. Notice the multiple triggers here, declared, distributed, or paid. Whichever of those happens first determines your tax year. So, for example, if a massive company like Reliance declares a dividend in March, but they actually pay it out in April, it's taxable in the year it was declared. Oh, and for those of you taking exams in the upcoming cycle, you absolutely must note a recent and crucial amendment. Act Number 4 of 2026 amended this section, substituting the reference section 240A to E instead of the old F. Write that down. Always quote the updated law to secure your full marks. Next up is Part 4, comparing dividend types, regular versus interim. Now, what's really interesting about this slide is the profound difference in timing triggers. For a regular final dividend under 7.2a, the trigger is the year it is declared, distributed, or paid. But for an interim dividend under 7.2b, the law states it's deemed income only in the tax year. The amount is unconditionally made available by the company to the shareholder. Guys, unconditionally made available is your mega keyword right here. For instance, if a company announces an interim dividend but makes it subject to RBI approval, well, it's not deemed income yet. It only becomes taxable when the shareholder has an absolute, unrestricted right to actually take that cash. All right, let's bring it all home with Part 5, the Section 7 revision summary. Let's move to and see how this builds our ultimate study guide. Honestly, I highly recommend taking a quick screenshot of this matrix right now. To lock this in your memory, just remember a very simple trick. Section 7.1 is for employees, and 7.2 is for corporates. Under 7.1, we've got employee funds. 7.1a is the annual accretion to a recognized PF governed by Schedule XI Part A, Para 6. 7.1b is the transferred balance governed by Para 11 of that same exact schedule. 7.1c is the Section 124 pension contribution deemed in that specific tax year. Then, boom, we shift to corporate dividends under 7.2. 7.2a is your regular dividend, triggered the year it's declared, distributed, or paid. And 7.2b is your interim dividend, triggered only when unconditionally made available. Memorize this underlying logic, and you will absolutely ace these questions. Before we wrap up, I want to leave you with a provocative thought to ponder. If the government has the power to simply deem that you have received income, even when your bank account hasn't seen a single rupee, how does that fundamentally change the way a business or an individual must approach tax planning? It forces us to realize that just managing cash flow isn't enough. We have to manage legal triggers. I really hope this explainer made Section 7 crystal clear for you all. If you found this breakdown helpful for your CA, CS, or BCom preparation, please hit that like button, share this explainer with your study groups, and absolutely make sure to subscribe to Fingraph India. Don't forget to press the bell icon so you never miss our future, easy-to-understand Income Tax Act 2025 updates. Keep studying smart, and I will see you in the next one.